Hi everyone. Hi everyone. Thank you for being here. I'm here with Sophie Manigart and Jan Alexander, representing Vlerick Business School and Private Capital Belgium. Today we'll be talking about private equity trends for 2025. I'm so happy to have you all here. It's our second webinar of this type with openthebox. I'm very excited to have these wonderful guests on here tonight. Let's start before we get into the deep work and the deep talking. Just once again introducing all of the participants here on the stage. I'll start with Sophie. Do you want to quickly introduce yourself?
Okay, thank you, Jona. Thank you for the invitation. It's my pleasure to be present here at this webinar. I'm Sophie Manigart. I'm a professor at the Vlerick Business School and at Ghent University, and my area of expertise is entrepreneurial finance. So I have been researching issues like venture capital, private equity buyouts, angel investors for a couple of decades now. But I'm also involved to some extent with the real world, with what you call the real world then, being I was the board member at GIMF. I'm now a board member at PMV. Most of you will know that. I'm a board member at Private Capital Belgium, formerly the BVA, the Belgian Venture Capital and Private Equity Association. I'm also involved with Cubic and with a small Dutch venture capital, growth capital fund as well, as a couple of examples.
All right, so you have a few activities, basically. No, very impressive. Thank you, and we'll move on to Jan. Of course, both of you, to the extent you even need to introduce yourself to this audience.
Yeah, hi everyone. My name is Jan Alexander, Secretary General of Indeed, as Sophie said, Private Capital Belgium, our brand new name. Until yesterday, we were called Belgian Venture Capital and Private Equity Association. We thought it was time for a new name, for a new logo, and we're also working on a new website. My background is also, wouldn't surprise you, private equity, venture capital. Have a long-standing career, mainly at KBC Private Equity and then at PMV. And now I'm heading the association, so the Belgian Association for Venture Capital and Private Equity, which is an industry body for the VC and private equity business. And next to the association, I'm a member of the advisory board of MC Capital, which is a fund of funds focusing on tech funds, and also of the advisory board of Vectis Private Equity.
Nice. Very wonderful to have you both here today. I'm here on behalf of openthebox. So I'm the Chief Revenue Officer of openthebox. What is openthebox? We provide real-time data insights for faster decisions for private equity funds, for M&A advisors and corporate finance teams, and for banks. So a lot of private bankers, corporate and wealth bankers use openthebox for their day-to-day decision-making and advising clients. All right, but of course, I'm mostly the moderator here. I'm lucky enough to be spending a whole hour with Jan and Sophie. Okay, maybe before I immediately show the first slide, I want to set the stage for what we'll be speaking about. Obviously, a lot of things have been moving in private equity, in the M&A space, and in the funding space in general. Jan and Sophie, some things that we've been seeing obviously over the past few years are the interest rates rising once again. Money in the market is moving into different vehicles, so into private investments, maybe more so than, or in more mature companies, perhaps more so than a few years ago. The M&A deals have seem to have been picking up again. I know it's a little early for bold statements, but what do you think, or what do you see with the members, especially Jan? How do you see how everything is moving right now?
Yeah, if you ask me about the current state of fundraising and M&A activity, I would say that times are challenging, even stressful here and there. As you say, we had this spike in interest rates, but following that, these are, let's say, more difficult years than the 10 years before. There's a lot to do about liquidity, or better, the lack of liquidity. I think that the industry, VC and private equity, can show nice returns over the last 25 years. And it has always been, on average for sure, but always been the case that more or less 25% of net asset value, so of all the assets that are within funds, that almost a quarter on average was distributed on a yearly basis. Now, if you look at the last Bain report of 24, you see a serious decline in the portion of distributions to NAV, to net asset value, coming, I said, from 25% to an all-time low of 11%, which is very low. That's for private equity. The average over the last years for VC was 17%, and there you see a drop to 7%. Reasons for that is that although, Jona, and you're right, last year exits picked a little bit up, but before that, 22, 23, the exit environment was not so good, so less exits. If you look at Belgium, for instance, the so-called crazy years, or the booming years, 19, 20, 21, showed exit levels in euros between 1 billion and 1.5 billion a year. These amounts have seriously dropped, so that's one thing, less exits. Then, if you come again to that ratio, distributions to NAV, there has been a lot of investments made during the years 2022. And also linked to the fact that there are not so many exits, the IPO route remains very much closed. We don't see that many IPOs, and that makes it difficult for GPs if you don't have these exits, you don't have the distributions, and so fundraising becomes challenges. It's not across the board, it's not for all funds, but it's definitely something that we see. So liquidity and the lack of liquidity is definitely something that I see when I talk to people. And then dry powder. Dry powder has been there for a while. That's in fact the money that has been raised, but that is not used for investments. Still a big amount. On a global level, you talk about more than 1 trillion euro. It's an abstract figure. It's a bit difficult to grasp. But if you, let's say, look at the Belgian market and you take one figure, only for VC, only for venture capital, that amount is higher than 1 billion. So there's still a lot of dry powder, meaning a lot of money chasing assets, meaning that asset prices remain fairly high for interesting investments. And what's the solution to all that? I think if you have a good relation with your LPs, and if you have time, you can sweat it out and talk to your LPs and say, well, this fund will take a little bit longer to return your capital. That can be an approach. And then also our industry is very creative in finding ways to create liquidity. You have secondary options. You see funds. You saw that with Afeon and their tech company TMC. You saw it also with respect to United Pet Foods, Waterland participation. It's also a nice example of a continuation fund. So these are things where the market could offer a solution to the lack of liquidity that we see at this.
That's going to be my cue to show the next slide. I think you've set the stage beautifully for a few things that I also want to put in front of Sophie. I think we see some things you've already touched upon. So there's new ways of finding liquidity, but also an increasing amount of open-ended or continuation funds in the current space, because you have to be able to hold on to an investment for longer. You basically need to be set up for the current situation. Would you agree, Sophie? And perhaps also, I think we were both at Asset Management tomorrow last week, so there was also a lot of talk about more retail investors and providing private assets to different kinds of investors than maybe traditionally was always the case. And how does this compare to the historic highs and lows in this market? Is this really a dip, or is this more of a correction?
Good question, Jona.
It's a packed question. I'm sorry.
And first, I do agree with Jan with his overview of the current situation, and would like to put it in a longer-term perspective. You ask, is it a dip? Is it temporary? Is it just a correction? Indeed, people who are new to the industry, there's many new entrants that we have seen in the last decade, especially 2019, 2020, 2021. It was really a boom in private equity, in the private equity space. And so many new entrants, both at the LP side, but maybe also at the GP sides, those teams running their fund. I do think that many are scratching their hair currently and experiencing for the first time this downturn. But if you take a historic perspective, these downturns have been there for quite a number of times. Typically, we have cycles. Yeah. We have seen the first boom that I still remember was the internet bubble in the end of the previous century that then burst in the years 2000. We saw a depression in the decade thereafter, picking up again up to the new bubble, different bubble, 2008, bursting the financial crisis, followed by the big global crisis. Everything went down again. And then we saw the rally in the previous decade up to that new, in my views, overshooting in 2020, 2021, with a normal correction at this point in time. Everything coming together, as you stated, also increasing interest rates, although the interest rates are much more important for buyout type of transactions compared to venture capital transactions. Venture capital does not use debt, so it's much less impacted by interest rates than buyout transactions would do. So is it a correction? Yeah, definitely. But from levels that maybe were too optimistic. Do we have to feel depressed? Personally, looking back, I do think that we still have a healthy industry that can rebound, that can go up again. So historically, what we also know is those investors that were daring to invest at the time of that kind of correction, typically did very well. Okay, because there's less competition, valuations are more normal compared to what we have seen. Well, normal depending on the perspective that you take, obviously. But now is a good time to invest. But I do acknowledge that many LPs do not have the liquidity to invest. So that's a tension that we have. If you are an LP with liquidity, you have to continue. Or if you've never invested in private equity, looking at it from the outside, now is the time to start building up a portfolio in private equity. I'm pretty much convinced of that.
And adding to that, we're using the word dip, we're using the word correction. Yeah, for me, it's too early days to say so. It's true that investment pace has come down, exit rhythms also slow down. But there's been an interesting study, I think it's Goldman Sachs who made it, that the quality of these net asset value, and there's a lot of assets within funds indeed, but the quality of these assets is still really high. So what can happen now is that we have a delay in distributions, but too early days to say that we see a correction here, or that performance of these vintage years will be far less than the vintage years before.
Yeah. Nevertheless, Jan, we know that valuations were quite high in 2019, 2020, 2021. Valuations went up year after year. So we also know that some late entrants that invested at high valuations are now considering potential down rounds or exits at below the value that they entered. That should not be a problem for those that were early round investors, but later investors might be hurt.
I agree. And there you could draw a comparison, and I hope that the comparison ends there. But the years before the GFC, before the global financial crisis, were really high valuations as well. And then we all know what happened afterwards. So indeed.
Yeah.
Yeah. So, but what you're saying, Jan, is for now it's a delay in the maybe it's how should we say, it's a dip in volume perhaps, but not necessarily a dip in value just yet.
Yes, and the issue
is that a fair assessment?
Indeed, and the issue is especially there for GPs who are fundraising. If you can show distribution, if you show first returns, your fundraising is easier. And now we see really some GPs struggling, first time GPs for sure, but also GPs running their fund 5 or 6. Yeah, and that means that this could lead to consolidation between GPs in the industry, or even GPs disappearing over time. So time will tell how these things evolve.
And it's a very Darwinian fight. The strong ones will survive. That I'm pretty comfortable about. So those that were indeed not able to show successes yet, either because they are just new in the field and were not able to show exits, slow exit environment, they will have a hard time raising new funds. That is absolutely correct. Teams that have been able to show good returns, good exits with previous funds, because they have been there for a longer time, they are definitely at this point in time at an advantage.
All right. And would we then say that that also contributes to that dynamic where on the liquidity side, new types of investors are looking, are being sought out, new types of new sources basically of the liquidity on the left side of this slide? Is that why we are seeing this dynamic now?
I don't think it has to do with the different type of investments, but your observation that the landscape is now much more diverse is absolutely correct. In the old days, we just had the independent management team setting up their own funds. Then we had big corporates starting their corporate venture capital units that are now well established. Some corporates have already some decades of experience with that. Not all of them. Some have set that up because they found that fancy and then retracted. What we now see is many family offices entering the game. Wealthy families, either managing their own money or pooling together the funds of a couple of families. We do see that private equity is absolutely very popular among wealthy families because they feel the connection with building, creating value, building a company, and they feel well connected to that type of activity. And for example, if they have sold their own business or cashed out in one way or another, they're very keen to reinvest that in new economic activity. And so this is quite new, new from a historic perspective again. So these are new players entering the field, and they enter the field. They all have different ways of working. They copy the basics of the model, entering as a shareholder, as majority or minority shareholder in a private company, growing the value. But then family offices may have a longer term perspective, okay, because they may not have that 10-year horizon of a typical private equity fund, which we all know is already an understatement of the real lifetime of a private equity fund. Few will be liquidated exactly after 10 years. Most will need a couple of more years. But family offices seem to have a longer term perspective compared to those independent private equity firms. Corporate venture investors will have more strategic objectives, again, that might impact the way they work together with their portfolio companies and their targets.
And it's interesting to touch upon that longevity and that longer term perspective. Maybe a question for both of you. There seems to be, or let me put it this way, I think probably also due to there being less exits, a reduction in exits, that also leads to an increasing amount or new funds popping up, being created, that are actually more intended for that longevity, that are set up so that the return of the fund isn't expected within six years necessarily, so that they're a bit better protected for this current environment?
I think
maybe Jan, do you see this among the members?
Yeah, if you're referring to evergreen structures, it's not new. I think and it's been around for 15 years, the eternal question: what is the best structure to do private equity, open-ended, evergreen versus closed-end? It used to be the mantra to go for closed-end. Now I'm speaking 10, 15 years ago, because it created focus within teams. You had 5 years to invest, 5 years to divest. But as Sophie alludes to, this now and then does not have a nice alignment with economic cycles. So there's been a lot of thinking about evergreen structures, and also about in-between structures. Sophie referred to family offices. They don't have that limitation. Holdings don't have it either. But you have a lot of private equity funds, and the names are out there in the market: the Smart Funds, the Smile Invest, the Crea funds. These GPs all have a kind of hybrid structures, whereby either they are evergreen, but they create liquidity moments every now and then, or they try to combine the best of both worlds, meaning patient capital, investing and taking account with the economic cycle, and on the other hand, offering liquidity and distributions, or at least the option for liquidity for investors. And I just wanted to add one thing to Sophie's point and your previous question. With the market indeed has grown in volume, and family offices are really welcome and doing well. But it's not only family offices. We also see high net worth individuals really active in the market, also fund of funds. That's volume. But next to that, we see sophistication. So you see a lot of specialized funds, consumer funds, restructure funds, impact funds, energy transition funds. So that's also a good thing and a good sign that our industry is maturing.
Yeah, absolutely, because that's specialization is really key to create value in the underlying portfolio companies, that I'm absolutely convinced of. So it's not the old model anymore, buying cheap, putting a lot of debt, sucking out all the cash from the company, paying off the debt, and then selling it at a higher price for whatever reason. It's really much more active, creating value within the portfolio companies. And that kind of specialization helps you to really understand industry dynamics, what drives valuation in a specific niche, in a specific industry. So being more specialized operationally helps definitely in that value creation exercise. So I think it's a good thing, both from an investor's perspective, but also from portfolio company perspective, obviously. Yeah?
I agree. And I think we've actually beautifully concluded probably our first chapter here on the evolving landscape. Before we move on, we have a question here from Sylvie asking whether the increase of buy and build activities in private equities could be a reason for an increase in a fund's lifespan.
Yeah, I tend to agree. A buy and build strategy typically takes longer to execute. You have to find the acquisition targets. Obviously, you can start acquiring companies from the first day if you focus on smaller acquisitions that you then want to integrate. But before being able to exit, you also have to show that you are able to integrate those newly acquired entities. So I agree that may lengthen the exit periods for investors engaging in that kind of activities. Yeah.
Okay, good. All right. And then let's move on to our next chapter. So we've discussed now the evolving landscape. Part of that landscape is also the family offices, which will actually, I think we can touch upon a bit more even here when we talk about the local market, like not just the landscape. Here I want to talk about how some actors are behaving differently, but also the opportunities that still lie ready to be exploited. Again, some of these are not necessarily, not everything is necessarily new. But we're in a different cycle than we were a few years ago. So where are the opportunities here? And I think we've already touched upon family offices to some extent, but it seems that a lot of them are actually starting to behave more like a direct PE investor rather than the family office investing through a private equity fund. Is that correct?
I do think that you have also very diverse approaches within family offices. The saying goes, if you have seen one family office, you just have seen one family office, implying that every family office has its own idiosyncratic way of working. What we do see is that the sophisticated family offices would combine the various ways of engaging with private assets. Okay, having one segment with direct investing, having one segment with fund of funds, because let's be honest, with your direct investments as a family office, chances are low that you will be able to tap the opportunities in Silicon Valley, in China, in India, unless you are Sofina, obviously, some can do it, but most family offices would not have the size to do that. So if you want to tap into those opportunities, you need to go through fund of funds. You need to invest in other private equity funds, either directly or through fund of funds. So we do see that sophisticated and investors would combine those different approaches. Yeah. Also, Jona, because
but they're less than. No, it's very hard. You take all the risk yourself. You're way more exposed, obviously. It also requires commitment. So it's a very different ball game, as they say. So yeah, but it seems that more and more family offices are willing to take the risk and even set up a team to make that work. What do you think?
I think it also depends on the maturity of the family office. Typically, they start as a founder who has he or she has sold the company. There's a lot of money to invest, but not a team. And in an ideal world, you would say then, well, I'm making my first steps with respect to VC and PE. So I start with fund of funds because I'm not really familiar with the asset class. And as things evolve, these family offices start to invest in funds. And the family offices then recruit a team. And then typically that's the tipping point where, most of these family offices are familiar with the asset class by then. There's a team coming in, and then you see more and more direct investment. So that's the evolution that you tend to see. Not always, because every animal is different, but that's an evolution that you see a lot of times.
Jan, that would be the evolution that I would consider theoretically the best, the best way to learn step by step. It's not because you have been a successful entrepreneur that you, by definition, are a successful investor. But nevertheless, unfortunately, we also see many family offices saying, we have been successful. We know the world of business. We know how it works. Now we're immediately directly investing. We're not going to pay a fee to those professionals. They are way too expensive. Let's not do that. We can do that ourselves. This is not the model that I would advocate. So I fully agree with your model, Jan, step by step and learning the trade by doing it.
Yeah, that makes sense. I know that we also discussed in our preparation call the opportunities that still arise. Let's start with the first one of private debt in Belgium, especially, where I think the consensus was that this is something that is still underutilized. It was also a topic, well, it was broached upon briefly, I think, last week at Asset Management Tomorrow as well. Private debt as an asset class, but also, as just an opportunity to still seize that market where the private equity market is already a lot more busy.
Joona, you're right.
How do you guys see that?
Yeah, we see more and more diversification in the investment targets of the private equity managers themselves. So first we had venture capital on the one hand, buyouts on the other hand, and that's it. Now we have growth capital where investors take a minority stake into more mature companies. So in contrast to buyouts where they take over the whole company, we have real estate infrastructure investments. We also have private debt. And it's a fascinating niche within the private equity, well, the private assets landscape, because we're not talking about equity anymore, obviously, we're talking about assets. Private debt is not popular in Belgium. Okay, we have a couple of funds that have tried it in the past, but the banks are so giving so much credit, so much debt to our local companies at low interest rates, relatively speaking, that there's no need for private debt here. But if you would like to invest in the private debt market and benefit from what's happening in other parts of Europe worldwide, then this is a strongly growing market, giving at this point in time highly attractive returns compared to the more limited risk that they take. Why? Because the market is still underdeveloped. So the demand for that kind of financial solutions is higher than the supply. So the suppliers are really well positioned to ask nice returns. And why is the demand increasing? That is because globally we do see that banks are really stepping down from providing direct credit to enterprises, giving the strengthening regulations. We also see that in Belgium, but the trend is much stronger if you look to the Netherlands, to Germany, to France, just our neighboring countries. Banks have retracted much more than they have in Belgium. So all those companies that wish to attract debt now have to turn to private debt providers. So I do see a very nice future ahead of us for the private debt niche.
All right. Do you see this opportunity being spotted already among the members, Jan, or is it something that
Yes,
that the players in the market are looking at?
I think Sophie has been fairly complete on that, so nothing to add. Fully agree.
Okay, That's good to hear. I think what we also discussed obviously was that pension funds especially in Belgium are more conservative in terms of their investments and the risk they are willing to take on. And on the liquidity side, that could actually be something where more outsized opportunities could also be created if the willingness to take on the risk can be created, of course. How do you guys see that?
Yeah, I think that's a big issue, and it's been an issue for a couple of years. I remember when I was still at PMV, we did a fundraising for Belgian Growth Fund, which is now at its will be raising its second fund. The idea was to pool money and to invest with a fund of fund into Belgian scaling companies. And for sure, very interesting for Belgian institutional investors, and fundraising was very successful with insurance companies, but not so with pension funds. And there we discovered that, the asset allocation of Belgian pension funds towards VC and private equity is very, very low, still too low. And I know we don't have the size, our pension funds don't have the size of pension funds in Holland, but there is quite a list of pension funds with assets under management between 5 and 15 billion euro. And that means that if they would increase their allocation to venture capital or to private equity to 5 or to even 10%, that would mean a lot for the industry. It's very important. And that's one observation. And a second one, there's a lot to do about high net worth individuals and retail, and bringing the opportunity of venture capital and private equity to that audience as well. There's a lot happening in the Anglo-Saxon world with even ETFs for the private market, trying to combine a kind of access to an illiquid market, and at the same time distributing every quarter. Very complex. You need very big organizations for that. You need regulation and so forth. And I think one of the obvious ways to offer access to the broader public is having these pension funds more active in venture capital and private equity, because if you look at the second pillar of these pension funds, this is money of the public. And so why not combine both things? So you would have an institutional investor investing, meaning that it's for GPs interesting, because otherwise they have a long list of individual investors, KYC issues, what have you. And so at the same time, having these pension funds investing. So for me, that's still one of my to-dos, to go and talk to Pensio Plus here in Belgium and to spread the word that this could be very interesting for our community for sure, but definitely also for the pension funds themselves.
Yeah, so definitely we need regulation that is more private equity friendly, that allows institutional investors to invest much more easily in this asset class. But when they allocate more to private equity for Europe, it would also be good if they would invest more in Europe and not immediately look across the Atlantic or other oceans to invest in other parts of the world. That's also something that we see too often, that our institutional investors, for one reason or another, would consider the European market as less attractive compared to the American market. Now, if you look at returns realized both in venture and in private equity over the last decade, Europe does not underperform the US. That has been the case in buyouts for decades already. So European investors are really good at buyout type of transactions. Valuations are more modest. That also implies it's easier to get in. So do not underestimate that. And we do see on top of that returns of venture capital in Europe, in the old days, they were definitely lagging compared to what was happening in the US. But the last decade, they really have catched up, have beefed up their game. We have now a much more professional early stage venture capital investment industry as well. And it's worthwhile looking at investing in venture capital in Europe as well. But you have to be selective, obviously. You also have to be selective if you invest abroad. So you have to do your homework and make sure that you are selecting well-performing managers, investment managers.
Yeah. So maybe I think that very well concludes again what we're talking about on this slide and in this chapter. I have one more question here. I think it's largely been answered maybe already by what Sophie has been saying, but basically the question is the reluctance due to regulatory constraints or something more liquidity driven, this reluctance to invest in private assets by pension funds?
For me, it's absolutely not liquidity driven because, as Jan Alexander said, if you compare the asset allocation of Belgian pension funds compared to what their peers in other markets do, they really underinvest in private assets. So their peers in other countries have the same liquidity constraints, and pension funds, by definition, have very long duration of their liabilities. They have liabilities that they have to cover for 20, 30, 40 years. They are the investors with the longest duration of their liabilities. So them, private assets is a perfect match from a liquidity perspective. I'm not stating that they should invest everything in private assets, obviously, but allocating something really matches their liability. It's very good asset and liability match.
Yeah, and regulatory constraints.
All right,
I think
so
the insurance sector has more regulatory constraints than the pension fund sector, so I don't see that either.
It's more to do with culture, risk avoiding, and also knowledge,
and
I
safety,
think. If you never invested in that industry, it has a lot of myths that have to be debunked, and so knowledge also plays a role. So.
All right, that sounds a bit like what is indeed actually the case. All right, let's move on to our next big chapter. Obviously, given this environment, I think we've covered most of the things that are happening in the market. There are a few things happening to every market in the world and to every industry in the world. I think the main one being AI, and with AI comes data. So what we see a lot when talking to funds, I apparently gave a thumbs up here. So what we see a lot with funds is there is a bit of an old way of working, given these new pressures in the market. I think we've also discussed this last time. It becomes very important for funds and the private equity players already in the market, aside from looking at all of the other opportunities and the new ways of dealing with a decrease in exits. I think the way a fund works also becomes really important. The efficiency of a fund, how do you guys see that, and how does AI and better data, better knowledge play into all of that?
Yeah, I agree. Efficiency is the word, and operational excellence is the word. If you look at it at the life cycle of an investment, starting with sourcing, the way you can use AI for data extraction to validate data, also in screening potential assets. There's red flag detection. I mean, recognizing of patterns. If you want to check for anomalies in track records or want to go through legal documentation, there's also better benchmarking. In due diligence, it helps you to better score, to better forecast. So, yeah, I would say, why not give AI a seat on your investment committee?
And obviously, if you look
Yes.
at on an international scale, some companies have been doing that already. And this research that has delved into what are the outcomes if you embed AI in your investment processes? And the very interesting outcome was that indeed the quality of the average selection of your deals will go up. You have fewer failures, but interestingly, you also miss the really top performers, the unicorns. Well, because you're looking at a past, and a unicorn, almost by definition, is highly disruptive. So this is something that AI, up to now, cannot recognize. Okay, so we still have, at this point in time, room for human creativity and seeing through the patterns to what potentially might be a really highly lucrative investment opportunity that AI would discard because it's out of the box.
Yeah.
And it's not only in the
I think this is also what we...
excuse me. It's not only in the pre-investment phase, I wanted to say, Jona, it's also post-investment. If you want to monitor your portfolio in an efficient way, you want to gain insights. And also, it can help you detect the right moment to sell, because it gives you interesting insights on what your competitors are doing, what the market is doing.
Yeah, exactly. I think what we also see with our best performing funds is they tend to have a few deal sourcing models running at the same time, because one model is good at this and another might have slightly different data inputs, but also definitely always have the human side alongside of it. Every fund can implement AI, but in the end, it's the team that is the real differentiator. It's the combination that is the fund of the future, is probably what I would say, which I think you guys would agree with. At this point in time. Yeah. All right. Okay. So yeah, I think we see the AI and data application across the whole investment process, but indeed afterwards as well goes beyond portfolio tracking, but also tracking valuations or theoretical valuations of other companies in the sector. What has been happening recently? Is the time opportune to exit? Yes, that all definitely makes sense. I think do you guys have anything else to add on AI and data in private markets? Exactly why it matters so much?
No, I think, but I think Sophie touched already upon it. If we want to ask us the question, who will be the winners in the future? AI is one of the things that you need to embed as a GP. It comes with a cost. And one of the things that we haven't discussed yet is size. Do you need to be a really big GP to be successful? It certainly helps, because then you raise larger fees, which allow you to do more investment on your own operational excellence. But it's not only about AI. Then it's about investor relations. It's about your ESG offering. It's about the whole broad perspective. I think our market, if you look at the companies, is an SME market. Most of our funds reflect that. We don't have these mega funds here. We probably don't need them here. But question is how the market will evolve there. Will we see more scale within GPs, or will these GPs keep on functioning with more or less the same fund sizes as they have nowadays? I don't have the answer.
Yeah, that makes sense. Yeah, you need the room, obviously, budget-wise, to invest in these in these projects. I've launched a poll for the attendees on how you guys see the added value of AI in private equity. Meanwhile, I will move on to another question here from Daniel. What is the magic formula to unlock the direct lending, so private credit market, vis-a-vis an overbanked market in Europe, especially in the sponsorless SME segment?
Hi, Daniel. I could expect a difficult question from you, obviously. Yeah? It's one of my former students.
Yeah.
I'm happy that Sophie takes this question.
Well, I find it a difficult question, Daniel, because I think it's for our SMEs a very good thing that we have banks that are still so supportive in some parts of Europe. And again, Belgium is really an outlier. Our SMEs are really well served by the bank. Already much less the case if you go to the Netherlands, other countries. So in those countries, we do see that private debt, private credit is much more active compared to what we have seen in the past. So this is a segment that really has been growing tremendously after the financial crisis, where bank regulations tightened considerably. So when there was really room for that kind of a new way of lending money to our SMEs. So I would not call for stricter regulations for banks, because I think it's a boon for the underlying companies that they are financing. I do feel that worldwide there's sufficient attractive private debt, private credit opportunities if you would like to invest in that segment beyond Belgium.
Okay. All right. So I think that concludes the matter here. If there are any further questions, don't hesitate to ask them. We still have a few minutes. As we wait for them, though, we have one last slide. So the Belgian market specifics. This is, again, not necessarily about something that is new. This is more about, okay, we are in a new cycle. Some inherent traits of the Belgian market still offer outsized opportunities, probably in the next couple of years, and we see this also in what some of the new entrants to the Belgian market in terms of funds are focusing on. Trajan Capital, which has entered Belgium, WAD Capital that started last year. Family businesses still remain an outsized opportunity in Belgium. We have more on average than all of Europe on average has, and we have so many times more than the amount of family businesses in the US. So this seems to be an inherent trait in Belgium that can still be exploited in terms of succession planning, also targeting with MBIs and MBOs. How do you guys see this? Is this still something that we can exploit?
Well, definitely. There's still many opportunities in this region that we can capitalize on. We still have a lot of very nice companies where the current CEO shareholders are close to or already over retirement age. And I do welcome all kinds of new solution that is offered to the market, like the new search funds that we currently see, where individuals are sponsored to search for a company that they would like to buy, financed by another party then. So yeah, it's really great. When talking about succession, Jona, one thing that I would like to add there is that what we should strengthen in the Belgian private equity market is a succession question within the private equity partnerships themselves. Okay, private equity investors, venture capital investor, buyout investors are so good at helping to solve governance problems, succession problems in the companies that they are investing in, while they sometimes forget to look at how they should treat themselves. Most of them are partnerships. We see partnerships. So I do think that we will see a lot of things developing along those ways in Belgium as well. We probably, in our neighboring countries, succession within private equity partnerships are more developed compared to what we see here. So opening up for new partners, for younger partners, ensuring that the older partners are able to exit in an elegant way. we haven't seen a lot of, I'm not saying it's completely absent, that's definitely not the case, but that is something that deserves more attention among the professionals, in my opinion.
You give me an idea for a next workshop, Sophie. And it's a consequence of a maturing ecosystem, Jona, because there's been a lot of VC founders, GP founders that come to their end of their career, retirement age, and the way of handing over to the next generation is important. There's a lot of psychology involved, there's a lot of money involved, there's a lot of planning involved, and you need to prepare that really, really well.
Okay, that's very good answers for these slides. I'm going to hop on over to our last one because we're in our final phase now with Q&A. I have 3 questions here already. So first one is from Vincent. I'll open it here. Is there any new increased pressure on management fees in this challenging fundraising environment?
Well,
go ahead, Jan.
I think so. And I think the balance LP-GP, due to the circumstances that we described, is a bit more in favor of LPs. So that's one thing that creates leverage for LPs to negotiate more on fees, because the years before it was a bit like hurry up, and you can be very lucky to be allowed to invest in our fund and don't discuss fees. That's one thing. 2, I've been in fund of fund for 9 years, and well, we've always been discussing about fees, and it's something that you should do, or you should team up with LPs to discuss fees. There's nothing wrong with that. And fees, in my world, the alignment should be that the fees are, let's say, the yearly fees, the management fees are not too high. There it should cover costs, but the alignment should be at the end with the carried interest. So that's very important. And then another remark is co-investments. Nothing new there as well, but co-investments can be a very interesting way as an LP. So you're investing in a fund, but next to that you're offered a co-investment right. And typically on your co-investment, you don't pay any fees, any carried or any management fee. That can be an interesting way to address the issue of fees and to lower your overall fee.
All right, I think that's a very conclusive answer.
Nothing to add.
Okay, great. Let's hop on over to the next one. I think we've already discussed a few, but what are some important value creation levers that PE firms should be using in 2025?
Well, the easy, between brackets, the easy years of selling cheap and buying cheap and selling expensive are probably over. So it will be more challenging now compared to the situation we had in the previous decade, where multiples just went up year after year. It's probably a more healthy environment now. And now we'll see who is really able to create value. So most important levers are really operational rather than relying on markets or financial engineering. You really have to be able to understand the dynamics within a specific industry and how a specific company can capture the value that they might create. That can be through growth, organic, acquisitive growth, buy and builds, definitely. We see a lot of still interesting opportunities in markets that are really not concentrated yet and still have potential for further professionalization. That's there to stay, absolutely. But also, again, we discussed IE at the level of the investors. Obviously, IE will also be important within the portfolio companies. How can they implement that? How can they use that to enhance value creation within the portfolio companies. How can they become more efficient? How can that enhance their offering, their attractiveness to the outside world? Will also definitely be in place there. We did not talk about ESG yet. It's not a sexy topic anymore. 2 years ago, it would be top of mind. Not anymore. We all know what has happened since then. Nevertheless, I still think that thinking about ESG in a good, rational way without overshooting definitely helps to create underlying value as well. Well-run companies with lower footprints, with good social environment will be more valuable in the end. That's my firm conviction and belief. Absolutely. So that's there to stay, I hope, in Europe.
Okay, nice. Jan, do you have anything to add?
No.
All right. Okay, then I think that's also another conclusive answer. Then the last one, we've discussed taxation in our prep, and because there's still so much uncertainty, we haven't addressed it in our webinar today, but I'll still show our final question here. So do we see an impact of the possible new surplus value tax in multiples for valuation or structuring for SMEs? Is this already impacting assessment of future value of these companies?
Mm-hmm.
This is a very difficult question that I gladly leave to Jan.
Yeah,
perhaps it's a little early.
No, but there will be impact for sure. What the exact impact will be, it's difficult to say. As you know, let's say that the new federal government has I mean, there are pluses and there are minuses. I mean, the plus is that the way of taxing funds and fund structures, I mean, the new government does not impact that. So that's the good news. And for sure, we'll have carried interest measures, but that's more specifically for the GPs. And then the so-called solidariteitsbijdrage, capital gains tax. Will have a certain impact. It's 10% that you lose, but there's only a high-level agreement that is public. We haven't seen any texts yet. If I am well informed, that's not for this month. It could be by the summer or by September that we see first texts. So a bit early days to assess this completely, because the devil is always in the detail with these things. And so I would reserve my answer, Jean-Patrick, there.
Mm-hmm.
Okay. Well, I think that is probably as deep as we can go on a tax that hasn't been launched just yet. So I think then Sophie and Jan, what rests me is to thank you for participating in our webinar. Thank everyone here for attending. I had a lovely time and a great discussion. I hope it was the same for you. And then we will see you all in. I'm sorry?
It's been a pleasure.
Absolutely. I agree.
Yes. Thank you for being here. Okay. Well, then I wish everyone a wonderful sunny evening and an afternoon. And then we'll hopefully see you again in the future.
Thank you.
Thank you.
Bye-bye.
Bye.